Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rumble.
If you find our talks useful, please consider subscribe, like, and comment underneath. And let's get right into today's analysis. So imagine looking at a business ledger and seeing, some of the most incredibly bullish signals you could ask for.
Right, on paper it looks fantastic.
Exactly. I mean, you just crossed a major commercialization milestone, over $100 million in annual revenue.
Huge barrier to break through.
Yeah, and you've built this incredibly loyal user base, right? Like 52 million monthly active users.
Which is massive for a niche platform.
And to top it all off, you've got a literal mountain of institutional cash sitting in the bank. But then, despite all of that good news, your stock price just plummets 26%.
It's a brutal drop.
It is. And that's the exact paradox we are unpacking for you today. We're looking under the hood of a company that is going through this really massive high-stakes transformation.
Right, because they aren't just a video platform anymore.
Exactly. They are trying to pivot. They want to go from being a niche video platform to becoming a vertically integrated AI cloud infrastructure powerhouse.
Which is an incredibly expensive pivot.
Right. So the core question for you, listening right now, is whether this recent sell-off is a glaring warning sign to just stay away entirely, or, maybe it's a golden asymmetric entry point.
And honestly, that disconnect, the gap between those positive operational milestones you mentioned and the plunging stock price, that is exactly where the actual opportunity lies.
Yeah.
Yeah, because when a business makes a structural shift, this dramatic, evaluating them based on what they were yesterday is just a fundamental mistake.
So the market is looking backwards.
Exactly. The market is currently punishing them for the volatility of their legacy video business, but they are completely failing to price in the massive infrastructure they're building for tomorrow.
Okay, so let's break down that revenue engine then.
Yeah.
Because the fundamental shift happening here is just fascinating to watch. Let's look at the numbers. Right, so full year 2025 revenue hit $100.6 million, which is a 5% increase from 2024.
And like you said earlier, crossing that $100 million threshold is a massive psychological and operational barrier. It proves that the platform can actually scale.
Yeah, but the tension really shows up when you look at the quarterly breakdown.
The Q4 numbers.
Exactly. Fourth quarter revenue was $27.1 million. Now, that's a sequential 9% bump from the third quarter, sure.
Which is good.
It is good, but it represents a year-over-year decline in their legacy video platform. And that's what spooked people, I think.
Well, yeah. But you have to understand that decline is precisely why this whole pivot is necessary in the first place.
Really? How so?
Well, the traditional digital advertising model is just incredibly volatile.
Right.
I mean, if your entire business relies on banner ads and, pre-roll video commercials, you are completely at the mercy of macroeconomic winds.
Because advertisers pull their budgets.
Exactly. Advertisers pull back the second the economy gets even a little bit jittery. So management recognizes that merely having a large audience isn't enough.
Not if the monetization of that audience is totally unstable.
Spot on.
But I want to pause on that audience for a second, because the moat they have built is pretty undeniable.
Oh, the user growth is staggering.
Right. They grew from just 1 million monthly active users back in 2020 to 52 million by 2026.
It's exponential.
And from a pure demographic and business strategy perspective, their positioning, this whole freedom-first branding, it was actually brilliant.
It was. It completely insulated them from direct competition with giants like YouTube.
Yeah, they captured a highly engaged demographic that was, actively seeking an alternative ecosystem.
Right.
Meaning those users aren't easily poached by other platforms. They are fiercely loyal.
And that loyalty is a critical foundation. But again, a demographic moat alone doesn't guarantee long-term profitability.
Especially if ad revenue fluctuates.
Right. So this is where the secondary moat comes into play. And it is basically the entire key to the company's future.
The cloud infrastructure pivot.
Yes. They are actively executing a pending acquisition of Northern Data assets to deploy massive graphics processing unit capacity.
The GPUs.
Exactly. They are moving aggressively into AI cloud services.
This reminds me so much of the early days of Amazon.
Oh, that's a great comparison.
Right. Like Amazon built all this massive server infrastructure
Yeah.
just to keep their own bookstore running smoothly during the holiday rush.
Right, they had all this excess compute power.
Exactly. And then they realized, wait a minute, the real profit margin isn't just selling books, it's renting out our surplus server compute to other companies.
And that became Amazon Web Services.
Exactly, AWS. And here we have a video platform. I mean, streaming millions of high-definition videos requires massive latent server capacity.
They already have to build the physical plumbing just to survive.
Right. So now, by adding these Northern Data GPUs, they are basically layering high-margin AI computation on top of that existing plumbing. They want to be the landlord, not just the tenant.
It is a textbook infrastructure play. I mean, media companies are valued at a certain multiple, right? But data centers and AI infrastructure companies, they're valued exponentially higher.
Because the margins are better.
Exactly. But, and this is a huge but, to execute that transition, you have to spend an incredible amount of money.
Yeah, which brings me to the massive red flag sitting right there on their balance sheet.
The cash burn.
The cash burn. In that fourth quarter, they reported a staggering negative 89.4% operating margin.
That's a tough number to look at.
I mean, to me, that doesn't just look like spending money to build a business. That looks like a bonfire.
It does look alarming.
Right. Like they are bleeding cash to acquire these assets and build this cloud. How does a company survive an 89% operating loss without, diluting its shareholders into absolute oblivion?
Well, in a normal scenario, an 89% negative operating margin would absolutely be a death sentence.
The market would crush them.
The market would force them to issue new shares immediately, and yeah, the stock price would collapse.
So what's different here?
They have a financial backstop that changes the entire equation.
Okay.
In late 2024, they secured $775 million in post-IPO equity.
Wow. So almost $1 billion.
Basically. And that round was led by Tether, so they are fully funded for this transition.
$775 million. I mean, a war chest like that buys a lot of patience.
It buys time, and importantly, it buys execution runway.
Right.
They don't have to panic.
Right.
And furthermore, alongside that massive equity injection, they signed a landmark $100 million 2-year advertising deal with Tether.
Wait, let me just think about the mechanics of that. If your total annual revenue is roughly $100 million right now,
Right.
securing a guaranteed $100 million over the next 2 years from a single client is practically unheard of.
It's totally unprecedented. It provides absolute revenue visibility.
Because they know exactly when that cash is coming in.
Exactly. It severely de-risks their top-line projections for 2026, which allows the management team to actually focus on deploying the GPU assets rather than, panicking about daily ad sales.
Okay, so they have the cash in the bank, and they have guaranteed revenue coming in.
Yeah.
Yet, if you look at the stock chart, it's an absolute bloodbath.
Let's talk about the technicals.
Yeah, let's look at the technical setup and how the market is reacting to all this.
Yeah.
Because over the last 3 months, the stock has plummeted 26%.
It's been rough.
It really has. It dropped 8% in just the last month alone, landing around $5.11.
Pushing the market cap down to roughly $1.74 billion.
Right. And the trigger for this specific drop was that fourth quarter earnings miss.
The JAP loss.
Yeah. The market consensus expected a GAAP loss of 10 cents per share, and they reported a loss of 13 cents per share.
Right, but we need to define what that GAAP loss actually means in this specific context.
Okay, break it down for us.
So GAAP stands for Generally Accepted Accounting Principles,
Right.
and it includes non-cash expenses, like the depreciation of massive physical assets.
Ah, okay.
Right? So when a company is aggressively buying servers and GPUs to build an AI cloud, the depreciation of that incredibly expensive hardware hits the earnings report hard on paper.
So it's an accounting loss, not necessarily money flying out of the bank account.
Exactly. So that 13-cent loss looks terrible in a financial headline, but it doesn't necessarily mean cash is bleeding out the door at that exact rate.
Okay, that makes sense. But still, I mean, a 3-cent miss shouldn't trigger a 26% collapse in a vacuum.
No, it shouldn't.
To me, the broader context is doing a lot of the heavy lifting here.
The macro environment.
Exactly. This recent drop coincided with some really severe macro-driven headwinds.
Yeah, the timing was terrible.
We had escalating geopolitical tensions between the U.S. and Iran, wild swings in global oil prices. I mean, the entire speculative tech sector was just getting hammered.
It was a huge risk-off moment for the whole market.
Right. So looking at this heavy downside volume, my working theory is that this isn't a falling knife scenario representing a fundamentally broken company. This looks to me like a clearing event.
I completely agree.
Like the macro fears simply shook out all the weak hands and speculative deadwood.
The psychology of the market right now absolutely supports that theory.
Yeah.
Oh, yeah. When you have an expected earnings report that misses even slightly in a really jittery macro environment, the short-term speculative money instantly flees.
They just dump the stock.
Right. The sellers become completely exhausted. So the bad news of that specific Q4 miss is now fully baked into that $5.11 share price.
It's already priced in.
Exactly. Historically, heavy volume on a sell-off that's driven by macro fears rather than internal systemic failure, it creates what we call a shakeout reversal.
So it essentially resets the valuation floor.
Precisely. The speculative excess has been burned off. So for you, the listener, looking for an entry point, the risk-reward profile becomes highly asymmetric right here.
Because the downside is mostly capped.
Right. The narrative is fully transitioning from volatile video streaming to high-value AI infrastructure, and the stock is sitting near recent lows just as the physical deployment of that infrastructure is actually beginning.
Okay, so if the technicals are pointing to a washout, we have to look at what the big institutional money is doing behind the scenes.
The whale watching.
Exactly. Because the sentiment here seems to be shifting away from that early speculative meme stock energy into a genuine fundamental growth story.
And Tether is the ultimate whale driving this.
They really are. I mean, not only did they lead the $775 million equity round, but they're also the primary client behind that $100 million ad deal.
It's a massive show of force.
And you also have early venture backing from Peter Thiel, which, that adds massive long-term credibility in Silicon Valley.
Absolutely. Institutional backing of that caliber signals to the broader market that the smart money sees a highly viable long-term technical strategy here.
Right.
But the Tether relationship is really what is accelerating their immediate product roadmap.
You mean the new features?
Yeah. We are seeing new rollouts like Rumble Shorts and a native Rumble wallet. They are actively trying to boost the average revenue per user.
Okay, but I have to challenge this Tether dynamic for a second, though.
Go for it.
Because having your biggest investor also act as your biggest customer is incredibly rare, and frankly, it feels a bit concerning.
It definitely raises eyebrows.
Right. Like, on paper, it is a $100 million vote of confidence.
Mm.
But in reality, is this a dangerous dependency? I mean, if the crypto market crashes and Tether has to pull back, does this entire revenue thesis just collapse?
Look, concentration risk is a totally valid concern, and it is the primary reason some of the more traditional analysts are remaining cautious.
It makes sense to be cautious there.
It does. However, you have to look closely at the mechanics of the partnership. It is not just an advertising buy. It is a deep ecosystem integration.
What do you mean by that?
Well, Tether is highly motivated to see this platform succeed because their equity stake is massive, right?
Right, they own a huge chunk of it.
So by integrating the Rumble wallet and crypto-integrated tipping directly into the video platform, the company is basically bypassing the traditional ad market machinery entirely.
Oh, wow. So they are essentially cutting out the middleman.
Exactly.
Instead of relying on like Google or external ad networks to monetize a video, the viewer can just transact directly with the creator using this embedded crypto infrastructure.
Exactly the point. It is a fundamental shift in how they view monetization.
That's fascinating.
And there is another layer to their specific market positioning that we should touch on.
Okay.
While they maintain a strictly neutral, platform-agnostic stance regarding the content they host, their specific demographic moat has sparked some really fascinating industry speculation.
Oh, right, the rumor mill.
Right. Unconfirmed rumors suggest their distinct audience base could position them uniquely well for exclusive government or political streaming contracts heading into the upcoming election cycle.
Okay, I want to be really clear to the listener that those are just rumors right now.
Absolutely. Completely unconfirmed.
But it illustrates the broader point perfectly. Owning an engaged, highly concentrated audience opens revenue doors that might be totally closed to the more saturated traditional tech giants.
Exactly. It gives them options.
So we have the massive financial backing, we have the infrastructure pivot, and this evolving product roadmap. Let's map out the actual catalyst calendar.
What's coming next?
Yeah, what are the tangible events coming up in the next 3 months that will actually make this stock price move?
Well, the first major hurdle is definitely the Q1 2026 earnings report, which is expected around May 2026.
What's the market looking for there?
The market is going to look completely past the standard user growth metrics. They want to see the first tranche of that $100 million Tether revenue physically hitting the balance sheet.
Proving that the deal is real.
Yes. And, crucially, they need to see that the negative 89% operating margin is at least beginning to narrow.
Showing some cost control.
Exactly.
Okay, so the second catalyst is the Northern Data Integration Update. And to me, honestly, this is the entire ballgame.
It really is.
Right. Any formal closing or concrete progress on deploying that GPU cloud infrastructure is the big signal. It proves they've officially entered the high-valuation AI data center market.
You are absolutely correct to highlight the Northern Data Integration. It is the absolute make-or-break moment for a company's valuation.
Because it's so complicated to do.
Setting up thousands of advanced GPUs isn't just a matter of, plugging them into the wall.
Right, it's not like setting up a gaming PC.
Not at all. It requires securing dedicated rack space, managing immense power loads, establishing industrial cooling infrastructure, and minimizing network latency.
It's a huge physical engineering challenge.
Huge. And without successfully executing that physical deployment, they just remain an unprofitable video platform.
But with it,
They transform into a dual-segment media and infrastructure company. That catalyst alone validates the entire pivot.
okay, so the third thing on the calendar is the macro and tech rotation. Because this stock has a very high beta.
Extremely high beta.
And for the listener, a high beta basically means the stock acts like it's on a trampoline compared to the rest of the market.
Good analogy.
Right. If the broader index drops a little bit, this stock drops a lot.
Hmm.
But conversely, if we see a broader relief rally in small cap tech, this stock could bounce massively.
It swings hard both ways.
Yeah. And because there is so much significant skepticism around the company right now, a sudden upward swing could trigger really violent short covering.
And the mechanics of short covering can create massive, rapid price spikes.
Because they have to buy.
Right. When investors bet against a stock by shorting it, they eventually have to buy those shares back to close their position.
Right.
So if positive news like, say, a highly successful Northern Data Integration, if that drives the price up quickly, those short sellers are forced to buy shares rapidly just to avoid infinite losses.
And that forced buying pressure acts like rocket fuel on a high beta stock.
Exactly. It creates a feedback loop of buying.
Well, we have spent a lot of time mapping out the upside here, but to be truly informed, you have to look the risks right in the eye.
Always.
What could completely break this thesis? Let's dive into the bear case. And number one is clearly execution risk.
It's the biggest threat by far.
Building an AI cloud from scratch is intensely capital-heavy and operationally complex. Like we said, any missteps in deploying those Northern Data assets will just burn through their $775 million cash pile with zero return on investment.
And that execution risk feeds directly into the profitability pressure.
Right, that margin.
The market is giving them a pass on the massive operating losses right now solely because they have the Tether cash sitting there.
It's a grace period.
But an 89.4% negative margin is a ticking clock. If they cannot build this infrastructure efficiently, the cash runway will evaporate much faster than anyone projected.
Which actually brings us to the new Chief Financial Officer, Mike Massey.
Ah, yes. The new CFO.
Right. He was brought over from Intel's Edge Computing Group.
Which is a very specific hire.
Very specific. Now, hiring someone with a deep background in edge computing is exactly the pedigree you want when pivoting to an AI cloud.
Sure.
But bringing Massey in isn't just about, trimming corporate expenses or balancing the books. He is essentially acting as a supply chain general for a highly complex hardware rollout.
That's a great way to frame it.
Right. He has to standardize how they buy, deploy, and power thousands of GPUs so that every single dollar spent actually generates computational power rather than just burning electricity.
It's about hardware efficiency.
Yeah. I mean, it sounds like Massey is the mechanic brought in to fix a race car while it's driving at 200 miles an hour. If he fails to instill ruthless cost discipline, does the valuation floor simply crack completely?
Honestly, yes. The entire bull case rests squarely on Massey's ability to execute that discipline.
No pressure on him, right?
Right. If the upcoming quarters show that the cash burn rate is persisting despite the new Tether revenue coming in, institutional patience will just vanish.
They won't wait forever.
No. A $775 million war chest seems massive today, but hardware infrastructure can drain an account terrifyingly fast if it's mismanaged.
And we can't ignore the geopolitical contagion risk either.
Right, the macro shocks.
As the recent 26% drop proves so clearly, this stock remains highly susceptible to broader macro shocks, regardless of its own internal progress.
It's tied to the broader tech environment.
Okay, so weighing the enormous, almost binary potential of the AI infrastructure pivot against the really severe execution risks, here's the final verdict for your portfolio.
Let's give them the score.
We're giving this a bullish score of 7 out of 10. It is the absolute textbook definition of a high-risk, high-reward setup.
The elevator pitch is pretty straightforward.
Go ahead.
The company is attempting a high-stakes, incredibly difficult transformation from a niche media platform into a vertically integrated AI infrastructure powerhouse.
Which is no small feat.
Not at all. But they are attempting this with a massive financial backstop, guaranteed near-term revenue from Tether, and highly strategic GPU assets.
Right.
So the recent macro-driven washout, which pushed the stock down to $5.11, it provides a highly compelling asymmetric entry point for the contrarian investor.
But the time horizon is totally non-negotiable here.
Right, you have to be patient.
This is a speculative long-term hold. We are looking at a 12 to 18-month window. This is definitely not a quick swing trade to capture next week's volatility.
You'll get burned if you treat it that way.
Exactly. You have to get the Northern data deployment and the Tether monetization actual time to materialize on the balance sheet.
Right.
You are investing in what their server racks will look like a year and a half from now, not what their video view counts look like tomorrow.
The market will eventually have to decide if it is valuing a media company or a cloud compute provider. And that transition just takes time to prove.
It really does. Well, to wrap things up, I want to leave you with a broader thought to kind of mull over as you watch this stock over the coming months.
Okay.
Consider the massive structural shift happening across the entire internet right now.
The whole ecosystem.
Yeah. For the last decade, the model has been very asset light. Media platforms hosted the content, but they rented their server space from giants like Amazon Web Services or Microsoft Azure.
It was cheaper to rent.
Exactly. But now, we are watching a company transition from just hosting content to actually owning the physical AI infrastructure, the GPUs, and the data centers.
They want to own the real estate.
They want to own the real estate. Think about how that fundamentally changes the balance of power online.
It's a paradigm shift.
It is. If owning both the digital real estate, the physical servers, and the content becomes the new standard for independence and profitability, will every major media platform eventually be forced to buy their own servers just to survive?
That's a huge question.
Right.
Yeah.
Are we watching the end of the asset-light era of the internet? Something to keep in mind as you decide if this infrastructure pivot is worth a place in your portfolio.